Good afternoon, everyone. Welcome to this new session in the Konnect Classroom series, where we regularly discuss about interesting and relevant topics happening in the world of investments. But before we begin, let me introduce ourselves. I, Anirban Ghosh, lead the product-related initiatives in the passives and alternative space at Edelweiss Mutual Fund. Together with me is Mr. Niranjan Avasthi, who spearheads the product, marketing, and digital business in the company. We are here today to discuss about the topic of passive investing, which is in the recent times garnering rapid popularity among Indian investors. And why shouldn't it be so? If you are one who has participated in equity markets in the last calendar year, would have found that many of these active funds are underperforming their benchmarks. To add to that, many of the funds are also underperforming the broader, markets. If you have, some of you would have delved further, you would have seen that there is a large divergence in return within the similar category between the best performing fund and the worst performing fund. For investors like you and me, it often leads us to wonder, should we have entered into the markets or stayed out? Should we have been into this fund or should we have not invested at all? We at Edelweiss Mutual Fund had pondered over these questions and have found that possibly passive investment strategy is an answer to all these dilemmas. But how? To answer these questions and more, let me invite Niranjan on board, who will walk us through this agenda, which will predominantly revolve around how you can build an optimal passive investment portfolio, but also touch upon other basic tenets of passive investing. Over to you, Niranjan.
Thanks, Anirban, and hi, everyone. Thanks, everyone who have joined today for this session. So as Anirban alluded, what we're gonna cover today is a short introduction into passive investing, why one should be looking at passive investing at all, some emerging trends in the passive investing space, and most importantly, the last two topics for which we all are here is what are the investment options within passive, how to choose or select a passive fund, and how to build an optimal portfolio using passive equity funds. So let's get started. Briefly, what are passive funds? So if you see, passive funds are a low-cost option which does nothing but simply mirror the index which they actually are benchmarked to. There is no fund manager bias, and it presents a very strong case for diversification. And because the investment strategy is known, where the index fund or ETF would be investing is known, there is a fair amount of transparency in it. So broadly, if you see, what are active and passive and what are the key differentiation. So if you see, I've put two images out here. One is a car, which is next to active investment, and one is a bus, which is next to passive investment. So if you see, passive investment is nothing but traveling through a bus. The route of the bus is stated, which is a public transport bus. You get into it, and at a junction where you want to get down, you get down. What you get while traveling through this bus is a low-cost, travel option, and you travel at an average speed, which is possibly at which everyone is traveling on that road. On the opposite side is an active investment where you have your own car. While in mutual funds, this car is driven by a chauffeur, which is your fund manager, but the speed can be lower or higher depending on the way the fund manager wants to drive it. And similarly, your returns will also be higher or lower based on how the fund manager or the driver is steering this vehicle. But it is very convenient maybe for many of investors, because this car can pick you up right from your house, drop you at the exact location. So it is a kind of a customized experience. But of course, this drive is a bit costlier. So comparatively, if you see, the objective of passive investing is very similar to a bus. It gives you an average return of the market. It is low cost, and it is, I would say, a very simple option for someone to get into it and get out of it. You don't. It's probably a hassle-free way of investing. On the opposite side, when you are having your own car, first you need to see which car you want to buy, then which driver is good for your car, at what speed the car would travel, is it matching your needs or not. So there are multiple things with multiple benefits. uh, in the investing world, passive investing, as we just discussed, is nothing but, let's take example of a Nifty 50 index. Now, in Nifty 50 index, you all know there are 50 constituents in the index, and a Nifty 50 index fund would just simply replicate or copy this index and have those same 50 stocks and replicate the index. The returns of this index fund will be exactly similar to that of the index, which is Nifty 50, minus some expenses and tracking error, which we'll discuss at a later part of the presentation. Versus an active investment, if it's a large cap fund and the universe is, say, top 100 stocks, the fund manager will not replicate the entire 100 stocks in the portfolio, but he will pick and choose. He will have some of his own views on stocks, and he would believe that these stocks would outperform. So he would hold these stocks at a larger portion compared to benchmark, so on and so forth. So these are the two basic, differences purely based on the investment strategy between passive and active. So why should you invest in passives? Of course, we all know that it's a low cost option. It's very simple, but most importantly, if you are a DIY investor and you don't have a mutual fund distributor or an advisor by your side, the entire process of getting into a right mutual fund is a lengthy process. First, which category you should be investing. There are multiple categories within equity mutual funds as well: large cap, mid cap, small cap, multi cap. So which is right for you? You need to search that. Once you arrive at the right strategy, say mid cap fund, there are probably 29-30 funds within the mid cap universe. You'll have to do all the research on your own if you don't have a partner or a advisor by your side. Even if you figure out, okay, this XYZ fund is a good fund for me, reviewing this fund at a set frequency, looking at your own asset allocation, tracking performance against benchmark and peers, is a lengthy process. So it doesn't only stops at selecting a right mutual fund, but also through the process of staying invested, you need to review and you need to see as far as active funds are concerned. At the same time, if you are going for a passive fund, you can skip a lot of stages in this entire process, be it selecting which fund to go within the category, because in large cap probably there is only one or two index that is available. Review allocation, performance tracking is not necessary, because end of the day passive funds will give you returns which are closer to market. So there is no case of underperformance or cyclicality of performance compared to the benchmark. So it becomes a simpler process, and you don't need to go through the entire process, which is a lengthy process, time consuming, and also needs a lot of study and expertise. The second is, which is another important point, is in active funds, because fund managers take certain calls which are against the benchmark, there could be cyclicality in the performance. And often because of these active calls, there could be a case that within the number of funds that are available in a specific category, the difference between, or the divergence between the worst performing and the best performing fund is very, very large. For instance, if you see in the presentation on the slide, recently, we checked the best performing and the worst performing fund in each of these category. For instance, in a mid-cap category, the 1 year performance, the best performing fund is say around 17% return, whereas the worst performing fund is -5%. So the divergence is more than 23-24%. Now, unfortunately, if someone was in the fund which has delivered -5% return, definitely it would be a tough decision for someone to continue in this fund, or even take a call whether to exit or stay invested. At the same time, we have also seen that some of the top performing funds immediately next year becomes an average, performing fund. So it becomes a very difficult decision, emotional decision to stay invested in active funds unless you are being handheld by some distributors, and also to choose which fund to go for. So the unpredictability of performance in the short run, of course, is usually very high in active funds, because fund managers have their leeway and they take different calls at different point in time. Whereas in index or in a broad-based market indices, this is not the case. Even if you compare all passive fund, maybe all Nifty 50 index funds that are available, the difference between the best and worst performing fund will probably just be because of maybe expense ratio or tracking error, and it may not be beyond 0.5 to 1 percentage point. So this is maybe another important point to note, why passive investing gives you a simple and a better long-term experience if you are a DIY investor. Now, just summing up, passive funds can solve most of these problems, which is a complex process of selecting a fund. So because they are simple solution to choose, you don't need to go through the entire process. They have consistent investing rules through which, if you go for a Nifty 50, the rules through which the Nifty 50 stocks are selected, they don't change very often. Once in a 5 years, there may be change in methodology, which is a slight change, or maybe change in constituents because of rule-based reasons. Otherwise, the overall investment strategy has always remained the same. So there is more consistency in terms of investing rules. It requires much lower efforts to track, and also the index, the way they are formed, largely they keep adding good performers into them and keep eliminating the bad performers. So over a longer period of time, as Warren Buffett says, it's very difficult to beat the market unless you are a smart investors. Even in active funds, as Anirban mentioned, in the short run, multiple number of strategies do underperform in the short run, because the calls which the fund manager takes may work in his favor or against him. But an index as a strategy as a whole is meant to give you broad-based average returns, and hence the experiences are more consistent. What are the trends which we are seeing in passive investing? So we all would have heard that in US, more than 50% of the AUM today is into passive investing strategies, whether it is debt or equity. India is not far away, I think. So in last couple of years, the way passive investing has taken a leap, the share of passive investing in the overall investment strategies are increasing. So more and more investors are coming to passive investing. They may not be completely into passive investing, but at least people who are also having active funds are now exploring or taking smaller exposure into passive strategies as well. And why it is important, we'll see in the later part of the presentation. But overall, the trend is quite healthy, and more and more investors are coming into passive investing. So now coming to the second part of our presentation, which all funds are available, which all strategies are available, and what should you keep in mind while selecting the strategy? So broadly, if you see passive funds or passive index funds or ETFs, they are divided in three categories. One is market cap based funds, second is factor based funds, and third is thematic funds. So market cap based funds are simple pure play index fund mirroring the index which are formed using market cap as a filter or market cap as a strategy. So most broad-based indices like Nifty 50 or Nifty 100 index are market cap based indices. The weightages to the constituents or the stocks in these indices are based on the free float market cap, and hence they are called market cap based index funds. World over, the largest share of AUM are with the market cap based indices, because largely what it is believed that everything is priced in the market, or everything is there in the price of the stock. So when everything is priced in, and if company is doing well, its market cap will grow because the stock price will also grow. Hence, broadly, market cap indices have been the go-to place for most, DIY investors or investors who are starting their investment journey. Factor-based indices are indices which, are made using some or the other filters. Like there could be a quality filter. So if you take an example of a quality index, what it will do is take all the 100 large cap stocks, put some quality filters like high growth rate, high EPS growth, low debt to equity ratio. All these qualities are put together, and the stocks which rank higher in based on these factors are selected. So maybe top 30 stocks, quality stocks based on these filters are selected, and end of the day you get a quality index which uses these scores. There are other factor indices like momentum factor. In India recently we have seen there is increasing awareness around momentum as a strategy, which does really well over a longer period of time. Value is another filter which we all know about. Quality, low volatility. So factor based indices are basically an addition to a market cap based indices, where they have another filter which is put in, and then the stocks are selected. Thematic indices are simple. They could be themes like technology, healthcare, consumption, and all the stocks in that indices on these indices are basically from that particular theme. So today, if you see in India, almost 80-90% or more than that investments or AUM are into market cap based indices. Factor based indexing is, or factor based index funds are just coming up in India. Some of the most populars are momentum, quality, and low volatility. And thematic index have also started, but at a very, very nascent stage. Just as an example, at Edelweiss, we have these, selected offerings in each of these baskets. So in a market cap based offering, we have Edelweiss Nifty 50, Nifty Next 50 index funds, which cover the top 100 stocks based on market cap in the Indian market. Then we have a very unique strategy called Edelweiss Nifty Large and Mid Cap 250 Index Fund. This is the only index fund in the market which covers both the large cap and the mid cap universe, and it reallocates, or I would say rebalances the exposure between the mid cap and large cap on a quarterly basis, which gives the investor a consistent equal allocation to mid cap and large cap over a longer period of time. Then we have also a market cap based small cap 250 index fund. On the factor based index, we just talked about, discussed about momentum and quality as a filter. So both these factor indices and index funds on these indices are available with Edelweiss, which is Nifty 100 Quality 30 Index and a Nifty Midcap 150 Momentum 50 Index. And lastly, we have one thematic offering in the healthcare space, which is quite unique. It invests, or this index actually constitutes 70% of Indian healthcare names and 30% of healthcare companies which are listed in US. So US being one of the most innovative markets for healthcare, it gives an additional benefit and an edge to the portfolio. So broadly, this is the basket of Edelweiss. Quickly, just wanted to mention here. Now coming to the last segment is how to build an optimal passive portfolio. So let's first discuss briefly on how to select the right passive fund. So even in the passive space today, there is no dearth of options. There are hundreds of funds out there, multiple indices which these funds follow. So how to select a right strategy or a fund? So the first step is, of course, to select the right asset class. So today we have index funds and ETF both in fixed income as well as equity category. So it's very simple. If you want to go for equity, you'll go for equity as a category. Then the next step comes is select the index strategy. A lot of people look at the index fund and then select, okay, this is this fund or this strategy is performing well. Let me get into it. But selecting 2 or 3 or multiple indices may not be the right approach, because different indices will have different filters, different strategy, also different market cap segment. So the risk return would be very, very unique to each of these indices. So selecting the right index strategy is very important. So if you're a starter investor, a broad-based index, be it Nifty 50, Nifty 500, large and mid 250, these indices are a go-to place if you are just a starter investor. So these are known as broad-based indices. Then there are market cap specific indices, which is a large cap specific, a mid cap, or a small cap specific. So, and then there are smart beta, which we just discussed what are smart beta. So once you get the asset class going, you need to select which index strategy you want to go into. So let's say you want to go for a market cap specific. You want to add a market cap specific exposure to your portfolio. Let's say mid cap. Once you go and select within mid cap, then you select a fund. While selecting a passive fund, these are 3-4 important points which you need to keep in mind. One is expense ratio, of course, because that will largely define how much away you will be from the benchmark in that particular index fund or an ETF. Tracking error is another important point which we need to look at. Tracking error and tracking difference. So in nutshell, what is a tracking error or a tracking difference? Tracking error is actually measures how well the index fund is mirroring the underlying index. So if the index over last 1 year has delivered maybe 20% return, but the index fund mirroring that index has delivered maybe 19.5%. The difference is usually because of expense ratio and tracking error, which is basically a tracking difference over an absolute period of time. That 0.5 is important because that will define how your experience is versus the benchmark. So a higher tracking error or a tracking difference is basically not good if someone is investing in a passive strategy. And lastly, you also need to see the AMC with which you are investing. Why it is important? Because, of course, there is no fund manager when you are investing in passive, but there is an execution team, there is an operations team, there is compliances, there is basically how well you are keeping your entire tracking error into a defined band. So the entire ecosystem which the AMC builds boils down to how well they can manage the tracking error and how long they can manage these funds at a given expense ratio. So these are 3-4 things which you need to look at while selecting the fund at the end. So a lot of people, first select the fund and then see, okay, this strategy fits me, and then they invest. But the right process is first select the asset class, select the index strategy which you want to be, and then select the right fund within that index strategy. The other thing is, if you also want to build a portfolio using passive strategies, and why it is important, we'll also discuss that. See, when you have a one broader index, say let's say Nifty 500 index fund in your portfolio, it will largely give you exposure of a broader market. But if you want to have a right asset allocation within equities, you can do it today with the help of multiple passive funds. So as we discussed, there are passive funds specifically in large cap. There are passive funds having exposure to both mid and large cap, then small cap. Plus there are smart beta strategies. So you can actually target a specific beta or specific risk return profile for your portfolio, and then design a mix of passive strategies and hold them for a longer period of time. So for example, if you're going for a high beta strategy, what I mean high beta in nutshell or in a simplistic way is high risk, high return kind of thing, right? You want to take a higher than market risk and have a portfolio that can give you good returns when things are good, but of course it will have a higher volatility also. Then maybe you can go uh, uh, in a strategy where you can create a strategy where you have one third exposure to a large cap index, which is probably Nifty 5 index, Nifty 50 index, a mid cap strategy, which could be a mid cap momentum, which is a very high beta strategy, and a Nifty small cap 250 index. Now, if you combine these three indices in one third proportion, what will happen is this entire universe is nothing but the Nifty 500 universe. But when you compare the risk or return profile of this combo with a broad-based market indices of Nifty 500, here you will see the returns would have been higher with a slight bit of higher volatility. So your risk return profile, moves up in your portfolio. Because in a Nifty 500, what happens is you get exposure into large cap, which is Nifty 100, roughly around 70%. Rest 20% is into mid cap and only 10% in small cap. But when you are creating your own portfolio using different indices, you can target a specific risk profile. And that's what we have done here. One third into large cap, one third into mid cap, that also into momentum strategy, and one third into small cap. So while you have passive as a portfolio or a passive strategy, but within passive, you have taken a strategic asset allocation call and made it look aggressive compared to a broader market. Now, similarly, moderate strategy, if you want to go, you can go with a broad-based Nifty large and mid 250 index and add a quality tilt, which usually quality tilt has a lower beta, or maybe I would say better risk adjusted returns compared to a broader market. And then lastly, a balanced strategy also can be designed using a mix of debt and a large cap index. So while these are not tailor-made solutions, you have to create your own solution. These are just examples on how you can target a specific beta in your portfolio, or also have low correlation strategies to reduce cyclicality of your portfolio using passives. Just to give you some numbers, as I mentioned, if you look at the return of aggressive multi-cap strategy, which we just created over 10-year period, while the overall exposure stays within the Nifty 500 stocks, the 10-year return has been around 22%. So if you see the 10-year return of aggressive strategy, which we just discussed, is around 22%. For the same universe, which is a broad-based index, Nifty 500, the returns have been 16%. So this is important that you can target a specific risk return profile and go for it. Similarly, for a balanced strategy, the 10-year return has been 12% with half of the volatility of that of Nifty 500. So lower returns, even lower volatility compared to broader markets. Now, another important question which we keep discussing is most investors today would also have active funds in their portfolio. So, do we completely switch out of active and then go into passive? Or if you are building a portfolio, should we just have passive? How do you mix passive strategy, or if you add passive strategy to your existing portfolio, is it a right way to build a good portfolio? Absolutely. Passive in India, there are two school of thoughts, and we at Edelweiss also, we have active funds, we have passive funds also. Today, as we, at this stage in India, there is a lot of alpha, specifically in mid and small cap space, over a longer period of time. So active strategies will actually help you gain that alpha. Active strategy also helps you when markets are going down. Most active funds actually outperform when markets are going down, because we forget that part. They may underperform, like large cap funds may underperform when there is a raging bull cycle, but they do outperform when markets are down. So overall experience, there could be low on volatility, similar on returns, but they do add value. So also a right strategy could be complementing passive to your existing active strategy. How it helps is, as we had discussed, in active strategies, there will be years where the strategy is underperforming the benchmark because the fund manager would have taken an active call on a specific stock or a sector, and the exposure in that strategy could be very different from that of the benchmark. So, for example, today a fund is overweight on maybe IT sector. If it was overweight on healthcare maybe till 3 months back, this strategy would have underperformed the benchmark in the short run. So during these kind of years or these kind of period, if you have a passive strategy in your portfolio which complements this, what will happen is the passive strategy will not underperform the benchmark. It will just match the returns of the benchmark. In that scenario, your overall portfolio returns will be taken care of. It will have slightly lower, cyclicality compared to a pure only active strategy. So this way, you can complement passive investing into your active strategy, active portfolio as well. Also, by adding specific passive strategies which are not available in specific passive strategy that are not available in the active strategy, you can also give a tilt to your portfolio. Like for example, at least in India, there are not much option as far as momentum as a strategy is concerned in the active space. Even if there is no long-term track record. So if you have a normal, active portfolio, and if you want to add a momentum as a strategy or momentum as a factor to your portfolio, you can just add a momentum passive fund to your portfolio. Also, if you want to add, if you see largely active funds, be it any active fund, largely 20-30% exposure of your portfolio is into banking. IT would be 10-14%, which is in line with the benchmark. Healthcare would be another 6-7%. But if you believe healthcare is going to do well, the way to add healthcare to your portfolio is buying a healthcare index fund, simply. So also you can give a tilt to your existing portfolio by adding specific passive strategies. So passives, at least in India today, has a role to complement active strategy. You can very well build a only passive strategy portfolio as well, if you're comfortable with that. If you're a DIY investor, only passive strategy could work well for you. And if you don't have an advisor to suggest you on active strategies, that could be good. But for a lot of investors, existing investors, this is also the way to look at passive, which complements your existing portfolio. So broadly, I think so. This is what we wanted to discuss. If you have questions, do post it on the chat window. And now I would request Anirban to take over and see what all questions we have, and if he also has any questions or points which I might have missed during the session.
Yeah, thank you, Niranjan, for such wonderful insights, at least for answering the age-old debate about active versus passive, that at least active should not be used as an alternative, but rather as a complement. So while we await questions from our investors, uh, I should rather ask you some questions which are in my mind. So uh, is is passive investing as a strategy suitable for a particular class of investors? And what I mean by class of investors means seasoned, non-seasoned, cost conscious, risk averse,
Right.
or because of the developments happening in this field, is it applicable to the broad base of investors?
Right, right. So broadly, the textbook answer to this, Anirban, would be it is passive funds are good for novice investors or who are just starting. But data says actually more evolved investors have taken the plunge into passive first. If you look at the data, most institutional and HNI investors have a larger share to passives versus retail investors. Of course, it is maybe because of the awareness level between these two class of investors. But broadly, the realistic answer is passive investing is for everyone who needs it. Now, who needs it? Whether it is a retail investor or HNI, if he or she doesn't have advisor or mutual fund distributor by their side, it's very difficult to select the right strategy.
Okay.
Then the go-to place should be passive funds. And then maybe gradually graduate to active strategy over a period of time. For evolved investors who are already into active strategies and want to target a specific tilt to their portfolio, for them also passive funds are there. On cost conscious, I think so. Most investors actually we end up spending too much time on cost. See, end of the day, the end result matters. And if your goals are there, if you're making maybe market link returns, whether it is active or passive, that 0.5 difference doesn't matter much. So passive is more about ease, more about using it to your benefit by targeting specific things or tilt to your portfolio rather than cost. Because if you are just investing in passive because it is low cost and not investing in active because the cost is maybe 0.5% higher, then at the end of 10 years, if active outperforms by even 1%, the whole purpose of that 0.5 difference, 0.5% difference in the cost doesn't hold true. So, cost should be the last filter while, selecting a passive strategy, but it should not be the first reason. The first reason should be whether you have expertise to select the right active funds, then go for passive. If you're just looking at market link returns and don't want to outperform market, don't want to go through that hassle, then passive is for you. If you have existing portfolio, you want to target specific to your portfolio or add a factor, passive is for you. So all these are more important reason than just cost, I would say.
Great. So what I draw from your answer and from your presentation is that the investors have to have a change in their mindset. Rather than seeking alpha, they would be happy to move with the market in the longer term.
Yes.
So from the selection, filters that you said, while you choose the best of the passive funds, do you think the size of the fund would have any role to play? Because in some of the particular categories we see, like if I can take up the mention of the small cap category, sometimes the size of the fund may hamper the fund manager from seizing certain opportunities. But in this case, does size have a role to play?
Right. So good and very important question. So specifically, size is not an issue in passive. But in specific categories, like, if you have maybe small cap fund, and in that, if the passive fund size is very large, it may lead to higher tracking error. So till the time you're looking at tracking error, and that's where, we have put that filter while you're selecting a specific fund within the index strategy. If the tracking error is lower, it is comfortable level within the peers, then, it doesn't matter. So one, size doesn't matter largely in passive. Even a 10 or 15 crore fund is as good as maybe a 10,000 crore fund in a Nifty 50, till the time the fund manager is able to manage the tracking error, tracking difference at a lower level. If the tracking error is higher, so there may be funds with lower size, but tracking error is higher because the execution is not being done well. Then, a smaller size fund is also of no help. If it's a larger fund and over there also the tracking error is higher, and there are cases where large funds also have higher tracking error than a smaller fund, then it doesn't help. So what is important is look at the tracking error, tracking difference. Size largely doesn't matter in passive as a strategy.
Got it. So coming to the next point, probably we have not touched much on it, but it is something that often comes up in the investor's mind. So the most popular forms of passive strategies are ETFs and index funds, basically. So these are the two platforms that are available for customers at large. So should customers choose at a particular platform while making their allocation?
Yeah. So another, very important question. So today, what is happening, at least in, with a lot of investors, I see they usually follow a trend that, or follow news that in US, ETFs are more popular than index funds. So ETFs are good. Of course, ETFs have their own advantages. Index funds have their own advantages. In US, ETFs are more popular because there is a tax advantage versus an index fund or another mutual fund. But in India, everything is same. So that advantage goes away. Now, in India, if you compare index fund versus ETF, it boils down to cost and tracking error. On ETF, because they are on exchange, if you are able to execute at a lower cost, brokerage cost is, kept in mind, and impact cost, of course, which is nothing but the cost of execution on the platform because of bid-ask spread. If all these costs put together are lower than the index fund cost, then ETF makes sense. Otherwise, for most retail investors, at least, who don't want to trade, who don't want to have that real-time NAV, or trying to time the market during the day, index funds are very good because it's very easy to execute, buy or sell, because it is through the AMC. There is no impact cost while buying and selling in index fund with the AMC versus buying, selling ETF on the exchange. Plus, you can set up your SIPs and all very seamlessly in index fund. And in the long run, catching that 0.25 or 0.5% difference during the day doesn't help, because over a 10-year period, it will not even have a second decimal impact on your overall return. So index funds are simple, and for most retail investors, index funds would be good. Important to notice, index funds today are as cheap as ETFs, at least in India. In US, the index fund average cost is maybe 20 basis point for S&P 500, but ETF cost is safe. The lowest cost is 5 basis point or 3 basis point. But in India, you get an index fund, Nifty index fund at 5-6 basis point. You get ETF also at maybe Nifty 50 is at 3.5 basis point, 4 basis. So the difference is not much. So cost is not a major differentiator here. Then you should see how seamlessly you can execute. For long-term investor, the advice is broadly stick with the index fund rather than ETFs.
Got it. So now coming to market efficiency. So we received a question from one of the investors. Of course, historically speaking, in India, we have seen that active funds have generated alpha, in the past. But as markets are getting more efficient, and because of the advent of the internet, information is available everywhere. So
Right.
do you see that in the long run, going forwards, passive investing strategies and index funds will perform superior to the active strategies, or rather, let me ask the question reverse around. Like, markets will be so efficient that active funds will not be able to hold edge over the broader markets.
Right. So it's a tricky question for a product guy who launches active versus passive, but I'll give you an honest answer. See, active funds, at least the way we see it, the depth of market in India, especially in the mid and small, is very, very shallow. The research coverage and all is very slow. Once you go beyond 250 stocks, the researchers or analysts tracking a particular stock goes down to 2 or 3 or even 1. So there is huge information edge or analytical edge when you get into mid and small cap universe. For that edge to come down and become negligible, it will take decades. So US market is probably 20-30 years ahead of India in terms of efficiency, in terms of the entire ecosystem. I was looking at some data. The number of analysts in India is probably around 400, 450, right? The number of analysts and number of stocks listed are close to 5,000 stocks. The number of stocks listed in US is roughly around the same number, 500, 5.5 to 6,000. I think so. It has come down recently. I don't have the exact number, but the number of analysts covering is more than 2,500 only in US. Forget about analysts sitting beyond US market. So the ratio is very low in India, and it will take decades for us to reach there. And hence alpha will be there. But again, it boils down to what you want and what you are comfortable with. Taking a call on alpha is very tricky. I myself used to think that large cap alpha has died down, but last 1 year we have seen large caps have come back. So it is, of course, because on the back of eliminating some stocks which had corporate governance issues and all, but alpha is there and it will stay. Of course, structurally in large cap, it is a bit difficult because the way the funds are structured, you have to invest 80% in only 100 stocks. So structurally, there is difficulty maybe in large cap space. But otherwise, I think so there is huge alpha to be made in coming decades.
Got it. So now coming to the quantitative metrics, you mentioned about tracking error, of course. So while an investor makes an allocation into active strategies, typically in debt funds, they are looking at YTMs and modified durations. If they go into equity strategies, they are looking at Sharpe ratios and beta and all of that. So apart from tracking error, do you see any other quantitative metrics to be tracked in an index fund, in index strategies?
Right. So, this process which is there, selecting asset class, selecting index strategy, and selecting the fund. Now, tracking error, tracking difference, all boils down while selecting a fund. But of course, there could be specific ratios which you can see while selecting the index strategy, like Sharpe ratio or certain risks ratio. Simple standard deviation can also give you an idea how this index strategies would play out compared to a broader market. So let's take example of a momentum strategy. Momentum will have a higher beta, but it may also have a higher return or a higher volatility with higher return. So on a risk adjusted basis, maybe it would look good over a longer period of time. So these metrics these factors would be interesting to study while you are selecting an index strategy. But when it comes to index fund, I think so tracking error or expense ratio and looking at the pedigree of the AMC, these are some of the most important things. You don't need to get into beyond these ratios, at least while selecting the fund.
Got it. So it is more of a question about whether you should expose yourself to the index rather than the fund, basically. So
right.
you take a call on the index based on your risk appetite.
Exactly. Okay. The right way is to select the index and then select the fund and select the fund.
Okay. So probably we'll take the last question. So is there a possibility that if you stay invested in a passive strategy, that there is a lower capital gains? Because typically when an investor comes into a passive strategy, probably he has taken a call on the breadth of the market, and he wishes to stay invested for a longer term rather than kind of getting suffered because of a wrong selection and probably churning his portfolio.
So I am not sure whether I got that question right, but is it a question that versus active fund you will make lower capital gains in passive?
Yeah, because you tend to probably stay invested for a longer time, and rather than kind of reviewing on your selection and changing your fund at a very short while, you stay invested for longer, basically.
Right. So actually it can work both ways. If you end up investing in an active fund and it underperforms, you exit, you get into another fund, it outperforms. The next fund, you exit and re-enter, underperforms. Broadly, maybe you will make returns that are below average. On the other side, it can be, you invested in a active fund and it happens so that it outperforms brilliantly. So both scenarios are there. The probability of happening either of these situations is 50-50, I would say. So in index fund, largely what you will make is what market is making with much lower efforts. And that you have to keep in mind, that you will not get into whether this fund is good after a year or should I go to another strategy. It's broadly, if you want to invest in equity for next 20 years and you don't know which fund manager would do well, which AMC would have what strategy to do, and how many fund managers would change in this active fund, you don't have all those time to track. Just simply invest in an index fund, broad-based index fund, and forget about it. So it's fill it, shut it, forget it kind of option, I would say. And one should look at index funds or passive funds from that lens.
Okay, thank you, Niranjan, for answering all the questions. Hopefully, we have been able to satisfy, kind of the investors' interest in passive investing strategy. For any further question, we request the investors to write to us or reach out to their relationship manager, as we remain always available to answer. Thank you.
Thank you. Thank you, everyone.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.